Hello everyone. Welcome to another webinar promoted by SoftExpert. Today's event introduces managing third-party and supply chain risk. The webinar will be conducted by Nicola Crawford, a results-driven global enterprise risk and change management professional. I wish you all a great webinar.
Welcome to the Institute of Risk Management's Managing Third-Party and Supply Chain Risk webinar. My name is Nicola Crawford and I'll be your host today and presenting the material for this webinar. And this is just a little bit more about me, but suffice to say that I've been doing risk management for over 25 years and have experience in supply chain and third-party risk management probably in the last 10 years across a number of industries, including energy, oil and gas, public sector, and financial services. And before we actually crack on with today's presentation, just wanted to, represent a bit of a scenario in terms of somebody waking up and reading the newspaper in the beginning of a bad day, reading that you have major third-party providers had a security breach, some of the questions that might be asked in terms of, do we actually use this third-party provider? Yes. Do we have insurance coverage? No. Have we contacted the regulators? No. Have we been contacted by the media? Yes. Are we prepared to respond to customers, media, and the board of directors? No. So hopefully, after having gone through the webinar that we're going to present today, we would actually wake up with not such a negative response. However, we also are going to touch on unprecedented times given the coronavirus and obviously the impact that that has on supply chain and third-party risk management capabilities. So in terms of just the agenda that we're going to cover today, before I get into that, I just want to cover a little bit of housekeeping. So there are a number of polling questions that I'm going to present to you as we move through some of this material, and it would be appreciated if you could actually contribute and participate in those. If you do have any questions, please feel free to ask, and I will probably spend about 15 to 20 minutes at the end of the presentation responding to your questions. So in terms of what we're going to cover today, obviously introduction, so setting the context, looking at definitions and the context overall for third-party supplier risk management. What are the key challenges in managing third-party and supply chain risks? Responding to third-party and supply chain risks, what's the regulatory perspective, because that does guide how our responses are done. And then third-party supply chain risks and enterprise risk management. So moving forward. Introduction. As I've said, I'm going to cover definitions, the extended enterprise, what are the rewards, and obviously with the reward comes risk. So in terms of definitions, supply risk management has been said that it's, service providers, IT suppliers that do not create what you expect from them and therefore has a negative impact on business performance. And third-party risk management is basically analysing and controlling risk presented to your company, your data, your operations, and your finances by parties other than your own company. So you see the distinction between the two is that there seems to be a much wider scope and definition for third parties as opposed to suppliers. The traditional suppliers, those vendors that provided physical goods and services, and in today's environment that can also be digital goods and services. Third-party risk, therefore, isn't just about the numbers, it's about relationships. And a decade ago, as I said, it was simply a vendor. Today, third parties include affiliates, marketing, associates, intergroup companies. So it's much, much wider, as I said, than the scope of just supplier. Although we do use it interchangeably, supplier, third-party risk, it is the scope of what you're looking at that will then drive. So what I'd like to do here actually is get you involved in asking a question, just two questions. And the first one is, how many suppliers does your organisation typically have? So if you could start responding to that, please, and let's see what that tells us. So the results show that from a supply perspective, 28% had less than 100, and from a third-party perspective, 50% had less than 100. On the supplier side, 100 to 500 was 32%, 500 to 1,000, 13%, and more than 1,000, 24%, and not sure, 7%. In the second vote, we had 50%, as I said, that's less than 100, and then 50% more than 1,000. So actually, interestingly, not distributed as evenly as the supplier perspective, but also quite a significant amount of more than 1,000, which shows the difference in the scope that I've just mentioned before. Okay, so now to move forward. So obviously the extended enterprise is, it has its rewards, and, over time, it's very, very rare these days that an organisation does not actually engage with companies and other organisations external to itself. And this is done for meeting strategic objectives, for increasing revenues or reducing costs, or sometimes just to cover an area of expertise that would be more efficient to be handling externally to the organisation than internal. So we've got some things like, improvement in quality, innovation, time efficiency, and distribution of different risks. But also, outsourcing also brings a number of risks in itself. And here, there's a good example of what some of these might be. For example, strategic. We've got strategic risks in terms of adverse business impacts and ability to deliver on strategy. We have things like reputation. We can't actually outsource accountability. So an organisation might do something, a data breach, for example, but at the end of the day, if you've outsourced that particular activity, it is your organisation that will be held to account by the public, your customers and others, and therefore reputation is very, very important. Operational risks, for example, failed internal processes, people or systems as a result of an inability of a provider to provide the service that was actually expected. And I've split these into outsourcing risks because we've got those that are generic to the outsourcing relationship itself, and then we've got those that are specific to the service that's being provided or the goods. And for that, we have specific things around compliance with laws and regulations. There's always an entity that says, okay, I have a policy, my cyber risk policy says our internal employees, contractors and the like have to do these certain things to comply. How does that then apply to your external third parties and suppliers? And as you can see, the range of risks is, enterprise-wide. And it's very important to understand that supplier and third-party risks have an impact on your enterprise-wide risk profile. They are not independent of your risk profile. There is an overall impact. So obviously, with the risks and reward associated with the extended enterprise and therefore the increasing numbers of third parties, we want to have a look at some of the challenges of managing third party and supply chain risks. So to look at this, I'm going to have a look at the extended enterprise, increasing scope of third parties and suppliers, limitations in current approaches to managing third party and supply chain risks. What are some of the implementation challenges? What about the increasing number of incidents? And obviously something quite timely, which is the impact of COVID-19 on the risk profile from a third-party perspective. So as we can see from this diagram here, this was taken from a piece of work that the IRM did back in 2015-16 on the extended enterprise. And it's, again, going back to the fact that we now have affiliates, marketers, intergroup entities, as well as our key supplier relationships. Therefore, we are, in a situation where no organisation today has direct control over every aspect of its operations or reputation. And as we can see from this diagram, it's quite this environment of our supply chain and third-party ecosystem or network is becoming a little bit more complicated. And again, we can see that the increasing scope of third parties in terms of what they deliver for our organisations. This is quite an interesting piece of information that, according to the Institute of Collaborative Working, up to 80% of direct and indirect operating costs for business can come from third parties, while up to 100% of revenue can come from alliance partners, franchising and sales agents. So the reliance on third parties does continue to grow, and obviously the more that this grows, there's increasing concern around the headlines around incidents. Now, there were a number of incidents regularly that were occurring that were publicised through the press as a result of third-party and supply chain risks. However, we will cover this a little bit later on in the webinar, but COVID-19 has overshadowed all of those, but we still need to be cognizant of the trends that have been occurring. So what are some of the limitations of approaches to current third-party risk management. This is also very interesting, is that only 50% of companies assess 15% of their vendors. So in terms of looking at criticality of our suppliers and third parties, we've got to ask ourselves, why does this actually happen? And from my own experience, there's always an assumption that the value of a contract or the criticality of a particular service or goods will drive the criticality assessment. However, if you don't take a risk-based approach, this could be fundamentally flawed and lead to a situation where there is an assumption that I have a contract value that is very high, therefore this must be a critical supplier, therefore we'll do the assessment. And therefore this is why sometimes we don't get a full assessment of all suppliers and third parties. And obviously the scope can be determined by materiality, but that's got to be a risk-based approach, as it then leads to a much better outcome in terms of our remediation activities, because otherwise it can leave a really, really big risk gap. Now, if we also look at the approaches in terms of, okay, for those organisations that do complete a assessment of their suppliers and third parties, we spend a lot of time doing the assessment, but only 10% actually doing risk remediation. So what are the things and controls that we need to put in place to make sure that the third-party risks that we have identified are actually managed appropriately? Implementation challenges. So obviously I think that, third-party and supply chain risks is not a snapshot-in-time activity. It's based on a landscape that is dynamic and constantly changing. And as I said, sometimes the situation that we're currently in, I think, reiterates that. There are constantly changes in regulations across different industries, where compliance risk can also change because our third parties also have to be compliant with the same regulations that we have to comply with. And that does actually then drive, as I said, a dynamic nature. And obviously there are certain things, geopolitical risks and other changes in the environment that can make this change quite rapidly. We also have economic pressures, so need for efficiency and cost savings. So how do you make sure that our approach to third-party and supply chain risk is efficient and effective without consuming a lot, being labour-intensive, use of spreadsheets and keeping those up to date, version control versus technology solutions. So obviously there has to be a return on the investment, and therefore taking a risk-based approach does allow to, I suppose, allocate priority resources. And, it goes back to the previous slide that I presented there about, the amount of assessment. So the upfront, beginning of the work in doing supply chain and third-party risk is very, very important. Also looking at de-risking, reducing the number of high-risk third-party relationships. So some organisations that I have worked through, had situations, probably 4 or 5 years ago, where they had tagged 30 to 40% of their suppliers as critical tier 1. And therefore, the amount of governance and due diligence required with those organisations is very, very intense. And again, it's how do you manage de-risking and reducing the number of high-risk third-party relationships without creating other risks, for example, such as concentration risk. If you de-risk and reduce the number of third-party providers, you end up in a situation where you end up with concentration risk in particular industries or particular locations. And again, COVID-19 has sort of really reiterated the importance of this. One of the key issues here is how deep into the supply chain do you go? And one of the key difficulties, from my experience, is improper monitoring of what we call fourth parties. So this is the third-party providers and suppliers of our third parties. And it gets quite complicated when we start looking down and how that is actually then managed. And obviously, as I've mentioned before, because this is not a snapshot-in-time activity, the emergence of continuous monitoring across a dynamic moving target and the need for the other dot points that I've mentioned, again, reiterates this challenge in implementing third-party risk management frameworks. So I talked before about the increasing number of incidents. And quite interestingly, we've had a number of incidents. For example, 2017, UniCredit, which is an Italian bank, through an outsourced provider, had a breach of 400,000 customer loan accounts. GoDaddy, which is, powers a fifth of the internet traffic across the globe, had 31,000 of its systems hacked back in 2018. And again, that was through an Amazon cloud service, allowing hackers and others to find out commercially sensitive information. And obviously these are on the rise. There are Equifax also, data breaches. So, data breaches are quite important. I recently read the BCI Supply Resilience Report, and in there, up until COVID-19 came into play, the top 5 areas of supply chain disruption risks were breakdown in IT and communications, adverse weather events, cyber and data breaches, disruptions to the transport network, and the loss of key talent and skills, not necessarily through illness. I think illness came quite far down the list, but it's very interesting to see how that will change, obviously, in this year's survey. And so, as I've said here, I've put there increasing incidents. Previous trends are no longer relevant. COVID-19 is exposing supply chain vulnerabilities, which are significant. Now, when I say not relevant, I've just given you some examples there of the key drivers of some of the supply third-party risks. However, if we were to look at this post-COVID-19, I think that would change, and I think that's really what I mean by previous trends are no longer relevant. And it's very important, and just to understand what the key impact has been of COVID-19 on the supply chain third-party risk profile of many organisations. Now, this is quite a busy slide, so I'm not going to go through all of these, but some of the, just to highlight a couple of the points here, if I look at, for example, number 1, supply chain mapping and impacts. Well, obviously, it's very important that you need to know the locations and availability and ability of your third party and suppliers to provide goods and services in terms of your own key areas of supply. We could use PPE as an example here, because location specific, obviously, lockdowns, the transmission of the actual virus itself have all had an impact on different on supplier abilities to provide some of this. Also, I take Turkey as a good example. Turkey seems to be providing an alternative source where they're sending PPE. They've sent it here, they've sent it over to the US, because they're a very heavily driven textile industry with the expertise, which they then switched over to, instead of making clothes, they're making gowns and PPE equipment. So again, it depends on location, it depends on government policy and such. Also, if I have a look at, for example, the availability of critical labour, which is number 4, again, location impact, the transmission of the disease in the particular country, that country's particular response, and how that is played out in terms of availability of people, because obviously lockdowns and so on. I also look here at distribution, agents, resellers, and the like. So in the current situation, we've got certain industries where demand and supply have increased. Demand has increased. For example, if we look at the retail groceries, we look at PPE. So where demand is outstripping supply, we've got to be careful around pricing, so our transaction costs may go up. We have a capacity issue in terms of being able to source additional supply where that demand has increased. On the other side, we also have a significant decrease in demand for certain things. So, for example, we look at travel and aviation, and the impact on that is, what do we do with those supply chains that now have to be stepped down? Very important is how are they then going to be revamped up in terms of when we all start to sort of return to normal, whatever that new normal is going to look like. We'll look at number 6, digital operations. We've got the rapid and accelerated use of remote working. Those organisations that were planning to go digital have had to actually do that in a very fast time, particularly those that are able to work from home, office workers and the like. But even just GPs, virtual consultancies, virtual sessions, and so on. So with this, for example, comes the increase of cyber risk. The technology for remote working, has that been all implemented appropriately, given that everything has been done quite rapidly? And again, it's very important to understand that these particular risks have an impact across the whole of the organisation. It's not just supply and third party. So you need to do a cut across to see what the impact of the third party supply chain risks are having on your overall enterprise risk profile. And again, so I've just given you, I'm not going to dwell on this particular slide, but I look at this, and these are just a couple of highlighted areas. And again, it is dependent on your industry, your location, but some of these, obviously, risks are amplified as a result of COVID-19, and I've mentioned some of these already. But key here is that your business continuity capability, contracts. So what do your contract terms tell you? Had you envisaged a business continuity scenario where contract and legal requirements come into play in terms of maybe offboarding suppliers because they can no longer provide you with what they were contracted to give you? Financial health is very important. Obviously, there are cash flow and liquidity issues across the supply chain, and of course, in terms of our own ability to pay. Again, so this will have an overall impact. And I've talked about fourth party, physical security and privacy, and obviously the performance of the organisation. So given the array of risks that third-party supply chain risk can provide, and particularly situations that the coronavirus has presented us, how do we actually respond to those? Now, in certain industries, there are specific regulations that relate to third-party and supply chain risk management that guide the type of responses that we actually have to put in play. I've just given a couple of examples here of some of the global regulations, and some of you will be familiar with the GDPR. There's also now the California data privacy, which is very, very strict. We've got the Foreign Corrupt Practices Act in terms of bribery and corruption, and we have a similar here in the UK. We've got the financial services, so FCA requirements, and so on. And when we look at what some of these regulatory focuses are actually asking for, these are some of the key areas in terms of the way that responses are expected to put into play. So third parties having to consider basically what is the risk of sourcing a particular process, product or function. So this is specific to the actual product or service that you actually want to outsource for. Due diligence of potential suppliers or third parties. So once a company has considered the general risk inherent with sourcing a particular risk, product or function or service, the second area is the selection of the third party. So it's the actual third party itself that provides the risks in terms of their own business practices, how long they've been going, their financial health, and so on. Obviously, as a result of outsourcing a service or product, then there are some contractual requirements. And some regulators actually say what should actually be in the contract in terms of content. And it sets the company's rights and third-party obligations to ensure that overall regulatory requirements and good business practices are actually met. And then there's the ongoing governance. So what happens post-contract? What's the oversight requirements in terms of the delivery of the product, service or function? And what's the ongoing governance in relationship to regulatory demands and good business practices? Because, post-contract periods can run for quite a period of time, sometimes as long as up to 10 years. So when I look now at the common features of some of these regulatory requirements, I just want to summarise here what they are, because it does actually drive what should be included in your third-party risk management framework and the responses. So threshold of materiality of third-party relationships. So you heard me talk earlier about the criticality of suppliers and third parties, and some of these regulations require that there is a materiality assessment that's undertaken, and that some of the regulations then only apply to those relationships which are deemed material. A definition of a service provider. So we've previously given definition of a supplier versus third party. Again, this will determine the scope to which the regulation applies. There are certain regimes that prohibit outsourcing of core activities. This is particularly so in financial services. Due diligence to the undertaking on all service providers and third parties. So you need to know, do background checks and know who you're actually dealing with. And having in place a third-party agreement that is signed by the service provider. And again, as I previously mentioned, it's prescriptive on the types of clauses that need to be included. Obviously, regulators want access to the information so that they can actually are able to readily assess whether the regulatory requirements are actually being met across the board. Client confidentiality to be maintained. A risk assessment to be undertaken, obviously, to make sure that the proposed party arrangement will not increase the institution's overall risk profile or exceed their risk appetite. Making sure that if any of the regime's requirements are breached, that there is notification in a timely and appropriate manner. And outsourcing of IT services requires some additional requirements in certain jurisdictions. So this actually does give you a bit of a baseline as to the type of responses that, could be had in place. I want to talk now briefly about third-party risk management and enterprise risk management and what's the overall governance framework moving forward. Now, this particular diagram is basically a representative of an enterprise risk management framework, but with each of the components of third-party risk included in terms of the type of activities. So as I've said previously, it's really, really important to make sure that the third-party risk management is part and parcel of your enterprise risk management. It's not a separate exercise. Some of the way that the controls and the assessment is done may be more detailed than what you may do with other risk types. But again, it all comes back to how does it fit into the overall enterprise risk management framework. So before I actually go into talking about this in a little bit further detail, I'll just have another polling question here. And it's really, do you have a formal third-party supply risk management framework that has been implemented? The answers are no, partial, yes, but separate to the procurement life cycle, yes, and fully integrated with procurement life cycle, and not sure. Let me start the voting that on now, and we've got 60 seconds for you to respond. I'd appreciate that. Okay, so we have 23% that have not got anything formal in place, 23% that have a partial, 15% that they have something but it's separate to the procurement life cycle, and 18% that have got a formal program that is fully integrated with procurement life cycle, and 16% that are not sure. So that's quite an interesting view, and I just want to go through in terms of the framework itself, because as we mentioned in our promotional material for this webinar, we are going to be running a full online course on third-party risk management in the middle of June. We're just looking at setting the dates now, and what I'm about to talk to you about will be the core content of that course in terms of how do you actually apply a third-party risk management framework and develop that and implement it. So we talk about risk identification. One of the key things to remember is that the third-party supply risk is made up of two component parts in terms of there is the risks associated with the underlying activity itself in terms of outsourcing, which obviously I mentioned during the review of the regulatory requirements, and then the potential risks arising from or that are heightened by the involvement of a third party themselves. So what we need to understand is who are our third parties and the type of relationships that we have, and what are the scope of products and services that are delivered and managed by those third parties and suppliers, and therefore what are the broad key risk types that they actually may pose to the organisation. This is very, very important, and obviously will set the baseline for when we then undertake a risk assessment. In terms of risk appetite, we need to ensure that the alignment of third-party risks to the target risk profile of the organisation. So So obviously, depending on how mature your organisation is in terms of, first of all, risk management and then third-party and supply chain risk management, will determine how you set your risk appetite. But in most simplistic terms, a lot of organisations may have a qualitative risk appetite statement and then a target risk level. So, you know, if you're using very basic sort of risk register and a 5x5 matrix, you may have, you know, colour chart that says I've got risks that are red, amber, green and blue, and you may then say I want to target level risk that may be amber or green. So, you know, at a basic level, risk appetite is qualitative statement and then target risk levels, but it has to be linked to the overall risks of the organisation. So we talk about operational risk and cyber risk. We may have a statement and a risk appetite for that. We need to link our third-party risk appetite back to those risk types, and then obviously a statement maybe that gives us an aggregate view. And this will drive the risk-based due diligence and governance requirements. So obviously for those organisations that pose a higher risk to us in terms of the third-party supplier risk profile, we will put in place a more stringent due diligence and monitoring and governance arrangements than for those organisations and third parties that are assessed as a lower level of criticality from a risk perspective. Once we determine risk appetite, we then have to say, okay, how are we managing to that risk appetite? So we go for our risk assessment, and our inherent risk assessment really is around looking at what is the risks with the underlying activity, the risks from the heightened involvement of the third party, and given the outcome of that inherent risk assessment, we have a level of criticality or level of risk of a particular supplier third party. We're then going to determine our due diligence, which is a little bit around understanding how some of those risks, inherent risks, would be remediated from a controls perspective, and understanding then the impact that would have on the risk level, and then prioritising which risks need to be remediated. When we look at the risk response, our mitigated action plans, what do they look like? For example, we might say that someone who is has access to our systems must have at a baseline be compliant and accredited to ISO 27001 because it has 113 controls associated with it. And obviously we would go around, how do we check that? We look at monitoring reporting. And again, a lot of some of these are then put into the contract as provisions in terms of managing the relationship moving forward. We then look at risk monitoring reporting. We want to have a look at how do we ensure that our risk profile is not changing without our knowledge, and that we have enough time to manage any changes in the risks. So we want to put in place some third-party risk indicators and thresholds that we would monitor on an ongoing basis. Again, one of the key things that we need to look at is our assurance. So how do we get assurance from our third party and suppliers to ensure that what we've agreed in terms of risks and responses to those are actually being implemented and that they are kept in play on an ongoing basis. Again, about event reporting, how do we manage performance and SLAs in terms of compliance with contract requirements, and again, it's the ongoing recurring due diligence. Now, obviously, underlying all of this are a number of other key activities, including the risk culture. So what is our third-party risk management policy? One of the key things that obviously relates to this in an organisation, because it's done differently across different industries and organisations, is the accountability structure and the target operating model. How does the three lines of defence actually apply in the context of third-party and supplier risk management? Because it can actually be a little bit blurry in some situations. Communications and training are very, very important to make sure that everybody knows what they're supposed to be doing, and making sure that we have the right third-party risk documentation from an audit perspective. And one of the key things that is very important is making sure that the third-party risk management process and framework is aligned and integrated with the procurement life cycle. So what do we do in terms of risk assessment when we are onboarding new suppliers? how do we make sure that we monitor our contract and our due diligence requirements in the context of the risks that they pose? What do we do in terms of offboarding and ongoing monitoring of our need to maybe replace or have alternative suppliers? So in terms of the overall risk management framework and the third-party risk, this is the core component of what we would cover in the course that we're planning to schedule for June. And also just want to cover here the governance requirements. So, this is obviously related back to the framework that I've just talked about, but, we've got policies, processes and tools. Again, it's just another way of looking at it from a governance perspective. So contract controls, risk controls, how do we ensure quality control and get assurance of that? How do we challenge, one of the key things that coronavirus has certainly brought up is, we have these SOC reports, so systems of control reports, that are undertaken, and there are different types, and some of those do involve going on site to our third-party suppliers, and actually reviewing and retesting some of the controls. Given the current social distancing requirements and post-lockdown, I don't think this is going to be possible. So how does that then change to a digital delivery and digital assurance? So see some of the challenges that we have in terms of the overall third-party risk governance framework. So in terms of the content of today's webinar, this is the material that I've actually covered. I'm now just actually looking at the questions. So we talk just these, some as, just having to look through here now. Some of these are technical questions. So if you've got any questions, could you please come back to me now, because we've got about 10 minutes where I can answer some of your questions. So someone has mentioned here about, strongly agree, accountability in the 3 lines of defence model of governance. Again, that's covered in quite a lot of detail. Sometimes, we have people working in procurement next to, like a business risk partner that would sit alongside the procurement function and guide and help, maybe line 1.5. So I'm just going to give you 10, 20 seconds now to ask any questions. If you could just type them in and I'll be able to respond to those. In terms of those people that have got, in terms of the voting, yes, there was a bit of a problem with the second voting functionality and other technical issues I can't deal with, unfortunately. But in terms of the content, does anybody have any questions around the content? Okay, the number of persons that voted on the first one was 140. On the second one, although I think it was a little bit, as I said, some people couldn't vote, and so obviously I think that the actual figures will be skewed. We had 65, and then on the last one, the actual number was 125. In terms of demonstrating return on investment for third-party risk management, have you seen any common metrics across industries? In terms of common metrics, this is quite specific to organisations because it does come down to the type of products and services that you're outsourcing and the type of organisations that you're engaging with. It's almost very similar to the type of metrics that you would have on the overall value that risk management offers to an organisation. However, I think that one of the key things is the key risk indicators. So if you're looking at the strategic business case for bringing on a third party or supplier to provide a product or service, I think that your KPIs need to relate back to that, both from a performance perspective and also from a risk perspective. I'm just looking now. Is due diligence related to so far as is reasonably practical, such as in OHS legislation? In some respects, but also, again, depends on regulatory requirements. For example, I do know an organisation that works alongside the financial services. It's actually, this is known. So Refinitiv, for example, have, I do believe, one business unit that responds to questions from other providers because they provide a lot of data to institutional clients. And they have a team of 25 people just doing assurance, i.e. providing responses to due diligence questions. so that it is quite time-consuming and intensive. So again, it is going to be dependent on the level of risk and the criticality of the supplier or third party. Okay, I'm just going to answer 2 more questions. In terms of the slides being made available, yes, they will be. You'll get an email from the IRM saying thank you for attending. There will be a link back to this recorded version, so you can watch it back on demand, and also further details around if you want to register interest for the actual online course that we're going to be running in June. You can actually do that also. Right. Do you think that financial challenges ahead are likely to increase the risks associated with third-party outsourcing, cost-cutting, reduced due diligence? How should we be raising this with the board? I think that actually the whole supply chain third-party risk landscape is going to change. I think that there's going to need to completely review the scope of activities, because the nature of the way that your business runs, your business models, I think, the new normal, as people are calling this, business models are going to change, which means that the third-party supplier landscape will change, which means that your risks will change. So from a financial perspective, I think that would be part of that review, because organisations are taking the time now to actually, first of all, understand the impact of coronavirus on their third-party supply chain and their overall risk profile of their organisation, but also, with the need to reinvent or review business model and operating model, will determine how that's actually done. We've actually got time for one more question. Should KPIs be embedded in the contract? So from my experience, the normal contract requirements usually have an SLA that goes with it. So we normally see KPIs, and so what would normally appear in the contract is the type of information and reporting that may be required from a governance perspective at a high level. And then in the service level agreement, the KPIs, the key risk indicators for monitoring performance of the contract are set through the service level agreement. So this is how we would tend to find this. Actually on the overall contract monitoring. So that's all we have time for today. I want to thank you all for attending. We've had a very good turnout. I think 380 people attending. So again, if you have any further questions that are absolutely, you want a response to, please feel free to contact the IRM, and watch out for the email and details of the how to express interest if you want to attend third-party course that we have in June, which will go into some of these in a bit more detail. Thank you very much.
On behalf of SoftExpert, thank you for the presence of everyone who participated in this event. If you have any questions, please contact the presenter via email. To see other webinars, ebooks, and white papers on this subject, please visit our website. Find out more about SoftExpert solutions for business compliance, innovation, and digital transformation. Thanks for listening. See you next time.